Hey everyone, Michael here. So in this video, we're going to have a look at Square and I'll walk you through what I'm finding when I read through the company report. I'll also share with you that what I do once I've finished reading this company report in terms of like extra research or more due diligence that I'm going to conduct. So why am I looking at Square? Well, actually, I've had the company on my watch list for quite a while and I've been receiving updates on my dashboard on Simply Wall Street. And sure enough, the news came up that actually Jack Dorsey, the CEO of Twitter and Square, was recently stepping down from his position at Twitter, effective immediately, to become full-time CEO of Square. And so that was really interesting to me because obviously he's that position he's been in, being the CEO of both companies, has been quite a contentious issue, and there's been many split opinions about whether or not it's the best way of doing things. And now that he's finally committing to one company, it's got a lot of people's interest and basically means that he can finally focus all of his attention on one particular company. And so I got the notification here on an article recently by one of the analysts at Simply Wall Street. So I was having a read through that, and basically he was saying that now he's allocating his full time to the company, which is great. But however, it's still like a very high valuation compared to the market and industry that it's in, and it really needs like a lot of growth, significantly high growth, in order to justify a valuation that high. So having a read through that, I was like, okay, I want to have a look at this company because I have kind of viewed it before. It's been on my watch list for a while, and so now the fact that it's also pulled back incredibly quickly, like 35% decline since like mid-August, I wanted to have a look at basically the position of the company, where its fundamentals are now, and if now is like a good time to basically consider taking a position in the stock, or if it should just remain on my watch list and I should just see how things continue to unfold. So I wanted to have another look at the company report, and here we are. So as you know, my research process, the first thing I start with is the snowflake. So here we can see it's a company that has like a really good future growth prospects, has an okay track record, really solid financial health in terms of its balance sheet, doesn't score well in terms of its dividend because it doesn't pay one, and it could be good value on like one particular metric, but in other words, it doesn't seem to be very good value at all. So again, this seems like some other similar companies I've seen, like high growth stocks that have a solid balance sheet. It's pretty common if they have a lot of cash and like just a solid financial position to see companies that are well funded and have really high future prospects. This is a common sort of snowflake to see, and just shows us that Square, and its snowflake is like a solid financial health company with really good future prospects. And now what I want to go and do is find out more details about exactly how it is. So the next part I look at is pretty much the risks and rewards. And so what I'm seeing here is basically that according to Simply Wall Street's estimate of fair value, it's trading at around its estimate. And so what I'll do is when I get to the valuation section, I'll have a look at the inputs and just see if I completely agree with them or not. And then also if I need to do more due diligence, I can then go off and do it and then come back and basically input my own numbers in like an Excel spreadsheet and then play around with it and see what numbers I think are fair to get my own estimate of fair value. So I'll have a deep dive into that and see what I think. The next reward it tells me is that earnings are forecast to grow 43% per year for the next couple of years. So that's solid. That's a very high earnings growth rate, and that helps support why it has such good future prospects. Earnings grew by 73% over the past year. So had an incredible past 12 months, which is really good to see. And I'll want to delve into like if there's any sort of accelerating growth that's been happening over the last year. As for the risks, though, it says there's a large one-off item impacting the financial results. Okay, so this 73%, while it's good, it might not actually be sustainable or at least legit in the sense that it's like recurring, right? So it might actually be the fact that there's just one item that was a one-off sale or something that has actually impacted the financial results, and this may have driven the earnings up incredibly quickly over the past year. That's something I'll delve into the past performance section and see if I can shed some more light on that. And the next risk it tells me is that shareholders have been diluted in the past year. Okay, so as an investor, it's not ideal to be diluted, right? You don't want to have your slice of the pie decrease. But in a case where a company is growing incredibly quickly and the size of the absolute pie is increasing, if you're diluted at a rate that's slower than that rate of growth, then that's obviously not as bad of a position to be in. But if I'm being diluted at a rate that is quicker than the rate the company is growing, like the size of the pie is growing, then that's pretty concerning, right? So I think in this case, the fact that it's such a high growth company, the dilution might not be an issue, but when I get to that section lower down, I'll just see what the rate of dilution has actually been and if there's anything I should be concerned about. So that's what I'll cover in just a second. So The next thing I look at is basically the competitors, and I want to see who this company exactly is up against, and if there's any potential better opportunities out there, right? And so I can get a great high-level overview just by looking at the snowflakes. So having a look here, I can see that the likes of Visa, MasterCard, PayPal, and Global Payments are its competitors, at least some of them. And having a look at their snowflakes, I can see that while Square has really good future prospects and good financial health, Visa seems to tick a lot of the boxes, except for maybe value. It seems to be okay value. MasterCard seems to do okay in future, or pretty well in future and pretty well in past, but pretty okay and average and poor in everything else. PayPal seems to be really good in financial health, really good in health, past performance, and like good future prospects, but doesn't do too well in the other dividend or value. And then Global Payments seem to be a bit similar as well, really good financial health, okay dividend, okay value, mediocre future prospects, and okay past performance. So just having a look at this, I might actually want to have a look at Visa, right? Because that's a pretty appealing snowflake, and it could signify there's like a better opportunity out there. So while it's interesting to see what Square's snowflake is like, and that it has like really good future prospects and good financial health, I think what's interesting is that Visa seems to tick a lot of boxes. And so part of my research process anyway would actually be going through and reading these competitors' company reports and seeing how they stack up. But part of this process as well will be to determine if, in terms of an opportunity cost, Visa might actually be the better opportunity, right? Because it might actually present a better value play, like similar sort of future prospects and past performance and dividend and everything else. So I'll keep that in mind, that this company might actually be one that I look into in terms of like an alternative investment rather than like analyzing the competitive landscape. But regardless, I still will look at these companies and see how they all stack up in this sort of financial tech space, and see what the kind of landscape is. So the next section I look at is the price history and performance. And I use this part of the company report just to basically get an idea of what developments have been occurring and what impact they had on the share price, right? So I can go all the way back to like 3 years if I want, and often I do. And I try and get an understanding of like what recent developments have been occurring. And so I can click all these updates here and, for example, like have a look at these most recent ones. Client update, Sendoso partners with Square. So this tells me like there's a Square's give and get local directory into its platform. It's integrating that. Okay, cool. So this kind of development tells me what's going on, and basically then I can see that, I memean, I can't exactly attribute this update to the share price decline, but it's interesting to see what has happened around that particular update. And so as I look through, basically what I'm doing here is I'm trying to get more of a fundamental understanding of the company, like the qualitative aspects of the business. And I'm trying to get more understanding of like the management developments, what's happened there, like the financial developments, the strategy developments, and like anything else. And then as I read through, I basically start to build like a thesis and a narrative around the stock that helps me understand the business itself, right? Not just all the numbers that are out there in terms of different metrics and ratios and all that sort of stuff. It's like I want to understand what's going on in the business. So that one, for example, partnering with Square, Sendoso partnering with Square, if that's how you pronounce it. And so looking at like 3 years worth of that can be really useful, because it then gives me the ability to like see what projects and new initiatives they're working on back here that may take years to play out, and see how it's kind of been performing here, right? Because I can have a look at like the strategy and management changes that they're taking on here, and then see if there's any of those like changes have had an impact on like the financial kind of results that come out in this later period, and see if it's like, earnings increased due to X project that was delivered 3 years ago. So that's what this section is really useful for, and can really help me get a great understanding of the qualitative aspects of the company. So I won't do it in this video, but after this, like outside of the video, I would read through all these just to try and get a deeper understanding. And this next section is very similar. So it's the recent news and updates, and I use it for the exact same reason. So here is basically all the recent updates that you would typically see on your dashboard as well, but obviously it's providing the company report here. So this is stuff like insiders selling or buying stock, financial results being reported, or even articles from our internal news team, which is the one I was just reading before, or articles from partners that we've teamed up with, like Seeking Alpha, where there's opinion pieces from authors who provide coverage there. And so just keep in mind, these ones from Seeking Alpha are authors, and it's their own opinions. So it's not like a buy or sell recommendation, it's just based off their own research. And what I find this really useful for is basically to try and get, like I said, more qualitative aspects of the company understood, but also like if I'm incredibly bullish on a stock, for example, right? Like I'm like I've seen 3 or 4 aspects, and I'm like, yep, super bullish on it, and I just have like blinders on. I don't want to consider anything else. It's like I'm kind of cutting myself short, right? Because it's like if I don't consider what other people think and like look at all these different aspects of like why people are bullish and why people are bearish, I'm then putting myself at a disadvantage because there may be some aspects in that bearish opinion that are really valid and I'm not considering, and I may be like, and I may read it and then go, oh God, like I didn't consider any of those aspects. I'm nowhere near as bullish anymore, right? So it's really valuable to read other opinions out there, and then it helps give you a more informed decision to like look at all the facts and all the opinions and all the different aspects that people are considering, and then I can make my own informed decision of like, okay, I see what you think with those bearish opinions and bearish aspects of the company, but I don't think they're that likely to be much of an issue. So I'm like I believe these more bullish things are more likely to happen, right? So I think it's going to take market leadership, or its losses at the moment aren't an issue and stuff like that. Where someone else may have like a bearish opinion because of X, Y, and Z, and I may go, yep, that's true, but I don't think it's a big issue. So that's kind of that process there, and that's what's really useful in this section. You can read all the analysis and the research from Seeking Alpha if there is coverage, and also just read through these other updates and see like, oh, okay, there's big management players who are selling stock, more players who are selling stock, and articles from analysts as well. So like I said, really useful to get like a qualitative understanding of the stock, and after this video I'd read through these and all the more updates too, just to add more color to the company, right? So the next section I look at is shareholder returns, and I pretty much just want to compare the stock to the industry that it's in and the market that it's in and how it's performed relative to them. So we can see here that the company's declined like 13% in the past year, and compared to the US IET industry, it's much worse, right? So it's copped a lot of the brunt of the recent decline, and it seems like the US IT industry has gone down as well, but Square seems to have lost a lot more since then. And same thing for the 7-day returns, to be honest. Like it's been even more brutal in like the more recent, decline. And as for the market, though, it's significantly underperformed, right? So the US market gained almost 17% in the past year, although this was closer to like 30% about a month ago. So it seems like there's been a broad sell-off, right? And it's not the only one that's been impacted. It's like the market has actually lost like almost half of its returns in the past month or so. So that's just something to keep in mind as well. So next thing I look at is basically if I'm not too familiar with a company, I'll read the about section and just try and get more of an understanding of actually what it does, right? Like those above are updates and opinions and stuff, but it's like unless I understand the actual underlying business, like what it does, what it sells, it's not very much use doing analysis and research, right? So obviously Square has like its core products, like its seller ecosystem, its Cash App, and it's got many other aspects as well. And this section here, for example, just tells me about more about them and what it's working on, so and where it operates as well. So if there was a business that I wasn't familiar with, I would read through that just to get an understanding of it. And so the next part is the fundamental summary, and I read this just to get a really quick high-level overview of some key metrics, right? So I have a look at market cap, 83 billion, pretty big company, revenue of 16 billion, pretty strong sales, and earnings of 537 million. So having a look at those three numbers there, that gives it a PE ratio of 155, which is pretty damn high, and a price to sales ratio of 5 times. So price to sales isn't too meaningful to me here, considering it is profitable, but still the price to earnings ratio of 155 is huge. However, I can't just look at that by itself, right? I need to consider what the expected future earnings growth rate is, and then see if that's relevant or if it's like relatively fair or not. So while it's 155 and that is high, I saw in the summary above that it was like expected to have earnings growth of like 44%, and so 44% is really high, and that kind of gives me some context as to, okay, investors seem really willing to pay a high price for the stock right now because they think its earnings will grow really quickly. So what I need to then go and do research and make a decision of like if I think like 44 times earnings growth is A, likely to happen because that's based on analyst forecasts. If I think it could be more or less than that, and then B, if I once I have my future expectations of like future earnings growth, what I think a fair price to pay would be to pay for that. So that's just something to keep in mind for like these sort of metrics here and how you can consider them. And the next section I look at is basically just a more specific and detailed breakdown of what we just saw above. So in order for the company to generate this $16.7 billion worth of revenue, it tells me that the company needs to spend $12.69 billion to generate. So in terms of gross margins, that gives it gross margins of like 24% and leaves it with a gross profit of like $4.1 billion. So while 16 billion in revenue is a lot, it actually costs quite a lot, right? Like $12.7 billion to generate that. And that's not exactly the highest gross margin business out there. There's much higher gross margin business out there. And it's quite interesting considering it's a fintech company. But one thing we actually covered on last year, and this was an article back in November 18, 2020, was we had a look at Square's earnings and results, right? So it had a huge revenue beat at the time, really smashed out of the park in terms of what analysts were expecting. But what's something that's really interesting to keep in mind is that, like, obviously revenue is growing at such a high rate, but its earnings weren't. And it's like, why is that? And it's like, well, actually, it has the Bitcoin part of its revenue, and it's the driving force of why the revenue went so high. But there's actually a catch, because this particular company actually buys. So what the point here was, the Bitcoin revenue is the total sale amount of Bitcoins to customers. Bitcoin costs are the total amount of Bitcoin that we purchase. We purchase Bitcoin to facilitate customers' access to Bitcoin. So what that basically means is the company has to buy the Bitcoin for the customer. And so you can see here for the revenue, at the time, it was like $1.63 billion worth of revenue, but the costs were $1.601 billion, right? So it's incredibly low margin business. Because they're actually buying the revenue, buying the Bitcoin, and then giving it, and then selling it straight to the customer. So in order to generate that sale, they had to buy the Bitcoin itself. So while the top line was growing so quickly, earnings didn't follow because they had to spend so much to buy it, right? Because it was just basically part of how this particular model worked, and they told us that in their quarterly letter. So that was really interesting, and that provides an insight as to why it costs them so much to generate so much revenue, because their Bitcoin revenue has just continued to climb, right? The fact that they can sell Bitcoin through their Cash App, or give you the option, to buy Bitcoin. The way they do it means they actually have to spend money themselves. So that's something to keep in mind with these margins here. They're actually the way they are because of the way the costs are incurred. And so with the $4.1 billion in gross profit, the company then spends $3.5 billion in its like operating expenses. And that's stuff like general and admin, like just running the offices, sales and marketing, like advertising and stuff, and then research and development, which is any sort of obviously like internal sort of research they're doing to improve their products. And then after they've spent all that money, $3.5 billion, they're left with $537 billion in accounting profits. So that gives it a net profit margin of 3.21%. So that's a very low margin business, right? They're running a very tight ship. And it's something to keep in mind, because it's like if they're running a tight ship like that, if there's any sort of change in revenue or operating expenses, even cost of revenue or operating expenses for whatever reason, then this net profit margin is subject to like a lot of changes, right? Because it is so slim. So it's something to keep in mind, like having a look at all these expenses here: selling, general and admin, research and development, and marketing, and like seeing if you think like how they're trending, and if you think they're likely to be higher in the future or lower in the future. And same thing with the cost of revenue, like how much it costs the company to build these seller ecosystem tablets, or how much it costs the company to buy the Bitcoin if there's going to be more demand for it. That kind of thing is very important to look into to help get an understanding of like where you think these margins could go, and also what new projects and products and services they're looking at offering, because that can also change, right? Like if they're offering a service as an add-on to their existing platform, then that service might be incredibly cheap to offer, but it brings in all of a sudden a whole bunch of new revenue. That would be a really good opportunity for the company to increase its gross margins. So that's the kind of things you want to think about when you look at these summaries. But at a high level, that's what we're seeing here. And so the very last thing is the debt to equity ratio is actually 182%. So that tells me it's incredibly high. But the fact that I've seen the company has like a 5 out of 6 rating for its, 5 out of 6 for its health, financial health, I think it might have plenty of cash on hand to actually be able to afford and service the debt. So not too concerning, but I'll get more details on that in just a second. So the first thing I look at here is the valuation. And as we can see, it's basically like, how is it priced in terms of absolute value and relative value, right? So according to Simply Wall Street's estimate of fair value, which is like a discounted cash flow analysis, it's trading pretty much at par as of today. So it's pulled back quite a bit, like I said, like 35% since August. And so now, according to the model, it thinks it's trading at roughly fair value. So one thing to keep in mind with this model is that it's like based off certain inputs and assumptions. And so certain inputs and assumptions like 6.6% discount rate or a 2% perpetual growth rate, if you were to personally think that they should be different, like if you want a higher discount rate to give yourself a bit more of a safety buffer, or if you think a higher perpetual growth rate is needed given it's like a high growth company, if you were to put it in your own model in like an Excel spreadsheet, and input those numbers that you want, it would change the fair value estimate significantly, right? So one thing to keep in mind here is just it's an estimate based on certain assumptions, but you can obviously have your own inputs as well. And so this is not an buy or sell indication, but it's telling me that, hey, if you were to use these inputs, here's what could be potentially a fair value. And so that's interesting to know, right? Because this is based off its future cash flows. And so I'll have a look in a second at the future section and see how they're actually trending. But according to this estimate, it's trading pretty much fair at the moment. And so it's not trading heaps below its fair value, but it's trading pretty much on par. So the next part I was talking about was the value and like its future growth versus its current price. And what I want to do is compare that to the industry and market that it's in. And so, like I said, it was the 155 PE, which is huge, and especially huge compared to the 34 times earnings for the industry that it's in, the US IT industry, and the market being 17 times earnings. So that says, oh, okay, wow, this is incredibly expensive, but I want to see what the earnings growth is for these relevant industries and markets as well, because if they're nowhere near as high as the 42%, then maybe that 155 is justified. So that's how to think about that, and we'll get some more color on that in just a second in the future section. So price to earnings to growth, that's not too meaningful to me here. Price to book ratio, not too meaningful to me here. Now, future growth section, this is the next part. So as we saw, it does really well, and it passes like 5 of the 6 checks. And so it has 44% annual earnings growth expectations for the next couple of years based off the 34 analysts that are covering it. So really high growth. And we can see here that basically it's just had huge top line growth. And I think, like that article was saying, it's been really helped by the Bitcoin purchases because of the revenue that's been generated from there. I haven't looked at the latest results, but I'll have to check out what they were recently to see how much it contributed to that 16 billion. But that article was written back then in like September 30, and it was 1.6 billion out of this 7.6 billion. So, actually, no, that was only for the 3 months, so even more than that. So that's something we need to look into as well, just to see how much that Bitcoin actually contributes to the company's overall top line. Because as we saw, that Bitcoin revenue is not high margin at all. There's a lot of costs involved with generating that revenue. So not much money flows through the bottom line for every Bitcoin sale that it makes. So that explains why the top line grows so quickly, but the bottom line hasn't grown as much. So I think that's why the business as well is trying to add more complementary services to its like seller ecosystem and Cash App and stuff like that, because it gets attention and user flow with like one particular part of the business, but then actually makes money from different add-ons that it offers its customers. So that's something I'm going to keep in mind with the model and like looking at the business and how I think it can make money going forward. So yeah, as we saw, $537 million in earnings for the past 12 months to this period here. So like I said, it looks like it's just expected to have plenty of top line, not as quick by the looks of it, but plenty of top line growth for the next couple of years, according to these analyst estimates. And yeah, like more of the same with these earnings here, right? 772 million by the end of 2023, but it's actually expected to decline a bit over the next period or so, like 208 million by the end of the year. And then what's this next one? 283. So yeah, quite a lull period over the next year, which is kind of interesting. But we'll have a look at this cash flow and free cash flow, cash flow from operations and free cash flow. And basically this is the cash flow from its core operating business, and free cash flow is basically cash profits, right? Because there's accounting profits, which is can be impacted by non-cash expenses like depreciation. And then there's free cash flow, which basically shows you the cold hard cash that the company is able to generate. And so it looks like here, since cash flow and free cash flow from operations are actually trending above earnings, it looks like there might be some non-cash expenses that are actually pushing earnings down pretty low. So when I go and research the stock, I'll try and see, okay, what are these non-cash expenses? Are they equity compensation? Is it heaps of depreciation? Like, is there some other aspect that is pushing earnings down compared to free cash flow? So that's something to keep in mind here if they're trending differently. But still, looks like there's plenty of growth in this particular business, so that's good to see. And now this section here is what I was talking about with the comparison to the industry and market. So it looks like the 155p might be a bit justified considering it has so much higher earnings growth expectations compared to the industry and market, right? 155 times earnings versus like 35 versus like 16 or 17. So 43% per year, if you compound that over time, that's a huge growth rate, and probably explains why people are willing to pay so much more for Square than they are for the other companies that are in the industry and market. So that helps give me some context around why people are willing to pay so much right now. So it passes all these checks, but its revenue isn't expected to grow as quickly as it has previously. So that's kind of interesting. And now this section here, basically it's the earnings per share growth forecast. And what I look for here is the trend of how earnings per share is supposed to be, or is expected to be trending, and also the range of estimates from analysts, right? So this blue line is how the earnings per share has trended. This teal blue line is how it's expected to trend. And this shaded area is basically how wide analyst estimates are. So the top line here being the most optimistic analyst, and the bottom line being the most pessimistic or least optimistic analyst. And so I can see here that actually all of them pretty much expect a decline over the next year, basically until the end of 2022. That seems pretty universal almost. And then, but a lot of them expect the earnings per share to increase by the end of 2023. So some expect earnings per share of like $3.33, and some actually still expect losses of like 1 cent per share by the end of that year. So this tells me there's a huge range of estimates, right? Like there's a lot of uncertainty around this stock, and basically not much clarity or conviction around a particular earnings expectations. So there's a lot of different opinions out there. So what I use this section for is basically, okay, I see there's a whole bunch of analysts' estimates out here, and there's actually a wide range. So there's not like a real consensus of like, okay, we all agree that it's going to reach X amount, right? So what I do here is basically then I go and research the stock, and I go and do more due diligence, and I go and look at all the different products and services it has, Cash App, seller ecosystem, the Bitcoin revenue, everything, and I try and get more of understanding of the business. And I try and look, okay, where in 2023 do I think the company's earnings per share could be, right? Like, if I look at all these different products it's offering and I see how profitable they are, and they're all all their gross margins and stuff like that, where do I think earnings per share could be? And now if I look at that particular business and make certain estimates, and I go, wow, I'm really optimistic, I think it could be at like $3.33 per share or more, then I may look at today's share price and think, wow, yeah, like, I am actually willing to pay a lot for it because it's, or not willing, sorry. I think today's share price is like fair or even undervalued because I think it's going to have so much earnings growth, right? Compared to everyone else whose the consensus is roughly around here. And alternatively, like let's say I look at the exact same business, I look at all those different aspects, Cash App, everything, and I'm like, nah, I don't think it's going to have much earnings growth at all. Like I really think everyone's overblown it. It's not going to have much earnings growth at all. And my estimates are down here at like 1 cent per share loss. Then I may look at today's share price and I think, oh wow, God, that's expensive. Like, no, I would not pay that much because of how little earnings growth I think is going to happen. So that's a really useful thing to consider. Like when you look at today's share price, it's like based off people's opinions of the future earnings growth potential. And this is obviously the average, but one thing is the net income and above. But like what's important to keep in mind is that like some people are very optimistic and willing to pay a high price, and some people are very bearish, meaning they're not willing to pay a high price. So then you have to go and make your own decision on like, okay, where do I sit, right? Like how bullish am I, how bearish am I, and why, right? So that's what I use this section for, and I come back here after I've done more due diligence. So this next part of the futures section just tells me about like how well analysts expect the company to allocate its shareholders' equity in the future in 3 years' time. And according to analysts, they reckon it's going to allocate shareholders' equity pretty profitably, right? So 27% return on equity is very good. Anything above 20 is pretty solid, and 27% is very good. So compared to the industry being 17.5%, that's solid, right? It's expected to be like a market or industry leader in terms of how well it allocates its equity, or at least it's above average. So really good to see that the company is expected to have profitable initiatives to invest in the future, because that's ultimately what you want as a shareholder, right? You want your company that you're investing in to be able to profitably allocate your money into really high return initiatives, right? And so analysts expect that this company is going to be one of those. So that's good to see. Now, the next section I check out is just past performance. I just want to see if the company has a track record or if it's really hard to forecast, and like how its current profitability metrics go. So seems okay, 3 out of 6 is pretty good. An annual earnings growth of 73% is huge, and that's very impressive. But I saw that particular part that said there's a large one-off items impacting the financial results, so I won't take that at face value. And I'll learn more in a second. So as we saw, huge top line growth, and like we said, there was a lot of it was contributed to Bitcoin revenue, and I'll have to check out more recent results to see how much Bitcoin is contributing now to the top line. But earnings doesn't seem to have grown in line with it, right? And we sort of had some color as to why. What I use this section for is basically just to see how operating expenses are trending against revenue, right? So as we saw above, the expenses that were after that gross profit were like $3.5 billion, and that's all the operational expenses. And so we can see that compared to the top line, it's not growing anywhere near as quickly, which is great to see. That's the kind of trend you want to see. You want to see that operating expenses aren't growing anywhere near as quickly as revenue, because that means the company's like reaching scale, and it's basically able to generate more than a dollar of revenue for every increase in dollar it spends on like its operating expenses. So reaching scale, and in this case, it seems like that's definitely the case, right? Like its revenue is growing incredibly quickly. So that's good to see, and that's pretty much what I use as section 4. Now, the checks we were just talking about was the quality of the earnings, and this is where we get that warning sign, right? So it says Square has a large one-off item gain of $244 million impacting its September 30, 2021 financial results. Wow, okay, so the company generated $537 million in revenue, earnings. But if we take off that $244 million, all of a sudden that virtually almost halves it, right? It becomes like $294 million or something. So if we all of a sudden now look at the current price to earnings ratio we're paying, it's not 155, right? That's based off including a one-off gain of $244 million. If we look at it now, it's like closer to 300 almost, right? Like 286 or something. If we consider the fact that it's like now 290 odd in earnings compared to not actually being 537. So that's why some people may think it's so expensive now, because you're paying such a high price. It's just had a large one-off gain in the September 30 results, and that's what makes it drop to like 150, right? The PE doesn't seem as high. But if you take out that one-off item, which isn't going to happen again, then yeah, it seems really high. And that seems to back up the fact that why in the future growth section, everyone expects earnings to decline, right? Because that one-off item won't recur. So everyone's like, okay, earnings are going to dip again before they expect them to increase in like 2023. So, okay, the PE ratio, actually, if I exclude that one-off item, is actually higher than 155. So it's even more expensive than I thought. So again, that's something I'll have to keep in mind, but I still need to see, I need to go and do research on how much growth I think is going to happen in the future, because obviously that's just very short term. I need to look like 2, 3, 4, 5 years in the future and see what I think is going to happen. And so as a result, profit margins, not as a result, but just coincidentally, profit margins are down from 4.1% last year. Not great. I prefer to see profit margins increasing, but it doesn't pass this check, so not the best sign. And just in terms of past performance, seems to have smashed it out of the park, but it seems like this last year of earnings growth, being that $244 million in one-off items, has really impacted the past year, right? So it had huge earnings growth, but it was because of that one-off item, so it outdid the industry and market that it's in. And as for the past 5 years worth of annual earnings growth, it's done really well, significantly outpassing the industry and market, so it's really, really powered ahead in that sense. But one thing to keep in mind is that it actually was loss-making back then, so that growth rate can be a bit skewed because it crosses zero, but it's still like, it's good to see that it's broken to profitability. And now the last part of the past performance is basically the current return on equity, and it's considered low, right? Like it's below the 20% we were talking about, which is solid. It's at 17.8%, but it's roughly in line with the industry. So pretty standard, but I think that return on equity would actually be a bit lower if we take out that one-off item. So it's not exactly too strong now, but analysts expect it to be strong in the future, so I'm more optimistic in that sense. And in regards to return on assets and return on capital employed, doesn't seem to do as well as the industry that it's in, only generating a return of 4.1% on its assets, but it's not an asset-heavy business, like it's not really reliant on its assets, so I'm not too concerned about that. And as for the return on capital employed, which is basically just total assets minus current liabilities, so it takes into account debt, it generates a return that's better than it was 3 years ago, right, when it was loss-making. So for this, I just want to see that it's moving in the right direction. And in this case, it seems like it is. So the company is allocating its capital well, which is good to see. Now, next section I look at is the financial health. And I just want to see if there's any risk of like bankruptcy or, debt being too high and any sort of inability to cover its interest repayments if it does have any debt. And it seems like it's not really an issue, right? So it passes 5 out of the 6 checks. And what I look for here is basically just do short-term assets cover short-term liabilities and long-term liabilities? And in this case, they do, right? So short-term assets being cash and cash equivalents, and short-term liabilities being any liability that's due within the next 12 months, which is stuff like accounts payable and stuff like that. And any long-term liabilities that are due past 12 months and longer, right? And so this company has enough cash and cash equivalents on hand, 10.56 billion, to pay all of them pretty almost easily, right? Just almost 5.5 plus 5.3 equals more than that. So yeah, basically has almost enough to pay them completely, which is great to see. So it's got plenty of liquidity on hand, and it's good. It's a good solid position to be in. So the next section I have a look at is just the debt to equity history and analysis. And what I try and have a look for here is to see how the company has utilized debt in its capital structure. And so we can see here, it's actually didn't have any debt. Well, okay, yeah, $0 back in 2015, and progressive, slowly but surely, it's actually just really actually quite levered up, and it's increased its debt considerably. But what we can see here is that actually it seems to have kind of moved in line and in tandem with the company's debt level, the cash has, sorry. And so it seems to have done I'll have to double check this, but I think it did a raise somewhere around here, like issuing some new debt, and of course its cash balance increased accordingly. And so while it has a huge debt to equity ratio, the check here is a net debt to equity ratio, so it includes the cash balance, right? And the fact that it has such a high cash balance means that the debt level or net debt to equity ratio is considered really satisfactory because it's got so much cash on hand to be able to pay it off. So I'm really not too concerned about the financial health here because it has so much cash available. But it's interesting to see, right? And so it had negative shareholders' equity 5 years ago, but it's now positive, and therefore it's actually improved. That's another pro, right? Back when it had negative shareholders' equity 5 years ago, meaning it had more debt than it did assets, that's a really bad situation to be in because ultimately, as a shareholder, you don't own any of the company, right? The debt holders, there's so much debt that there's more debt outstanding than there are assets on the balance sheet. And so if things were to go pear-shaped, the company would try and sell all of its assets to pay off its debt holders, and you as an equity holder would get nothing. So that's what negative shareholders' equity is, but it's not in that case anymore, so it's good to see. One concern, though, is that the debt coverage doesn't seem to be too good, so it's only covered by about like 14.5% of its operating cash flow, and so anything above 20% would be considered well covered, but 14.5% is pretty concerning by the fact that it's like it would take 6 or so years for the company's operating cash flows to pay off the debt, but considering it has so much cash on hand, I'm not too concerned. If the cash proceeds to decline heaps, but the debt doesn't, then I'll be pretty concerned because, like, while yes, it can cover its interest repayments, it doesn't seem too well covered to cover its debt, and therefore it might need to raise equity again. So that's just something I'm going to keep in mind. I'll watch how cash seems to trend in line with debt as well. I'll see if they're both reducing, or if like it's just cash reducing and they still have heaps of debt. I'll keep an eye on that, but that's where it's at the moment. And now this is what I would use to just have a deeper look at the balance sheet, but I won't in this case because it's not too concerning. And the next section would be the dividend, but I'm not going to look at that because Square is one of those companies that's like hugely high growth company that wants to reinvest in itself, right? So it's like as a management team, they have an option that, okay, we're making money in terms of the earnings they have. They're like, we can either reinvest in the business or like return this money to shareholders in the form of dividends or buybacks. And it's like, if they have really good reinvestment opportunities, like they apparently do in Cash, or like I believe they do in Cash App and all the other businesses they're working in, I, as a shareholder, would be like, yes, please continue to reinvest in yourself because I don't want that dividend. I would then have to try and reinvest that dividend myself somewhere else. Whereas if you have really high reinvestment opportunities internally, then I believe you should keep reinvesting, right? Like if the company was to generate return on equity of like 27% in 3 years' time, which it's expected to, if it was to keep reinvesting itself, it could just compound its wealth and compound and compound and compound. And as a shareholder, if you pay the right price for it, you're obviously set to benefit from that, right? So that's what I kind of want to see. I want to see a business that has high reinvestment opportunities and plenty of them. And it seems like this company is expected to have them in the future. Like it's obviously not right now, but it's expected to have them in the future. And so as a shareholder, I go, yep, keep reinvesting. I'm totally happy to just, not receive a dividend. I can go to other stocks if I really want to, but if I'm not a dividend investor, that's not really an issue. So I won't go through this dividend section here. And the next thing I look at is just management, right? So I want to see who the management team is, how experienced they are, and whether or not they're aligned with shareholders in terms of their shareholdings. Like, do they have stock in their own name and how much? And so first thing to check out, though, is that there's an average management tenure of like 5.3 years. That's really good, right? Like it means that the management team, there isn't a high turnover. So if that was less than 1 year or so, I would be pretty concerned because it's like management team is staying there on average for less than 1 year, meaning there's a high turnover. But in this case, 5.3 years is plenty, right? Very experienced, so that's good to see. Now, the CEO details, I just want to learn a bit more about who's the person at the helm. And here it's obviously Jack Dorsey, who we were talking about at the start. So 12.5 years as his tenure as CEO, and his compensation is $3. So very, very low, but I'm sure he's compensated in some other ways like options. And so I'll try and get some more color on that soon. But if I didn't know him too well, and to be honest I don't, so I probably will read this after the video, but I would read through this and have a look at like basically what he's done, what his experience is, and where he's come from. So CEO compensation analysis, I just look at this here and try and understand like if he is being compensated in alignment with the company's underlying earnings. And so kind of an interesting trend here, right? Like it looks like his total compensation back then in 2016 was $6,000. Meanwhile, and even 3,750 back then, the trailing 12 month stuff. But company was obviously loss making. $6,000 is nothing. So it looks like, he's now receiving virtually $3. So no compensation at all, yet the company's earnings are continuing to improve. So quite an interesting situation he's in where he's being compensated virtually nothing, and the average of companies his size is like $11 million. So really good to see there. And his compensation has been consistent with performance. In fact, it's been going different, right? He's getting paid less and the company's doing better. So that's good to see. And also he has a huge stake in the company, right? So I use this section here just to see who the leadership team is and basically what their experience is. So like I'd read through their profiles and try and obviously learn a bit more about them. Then I'd look at their tenure to see how long they are there, and like if they are experienced members, how much they're being compensated to see if it's fair or not, and how much ownership they have, like how much skin in the game, how much are they aligned with shareholders. And in this case, it seems like quite a lot, right? So look at these people. All of them have at least a few $1 million, in fact, a couple of billion from the two co-founders, and a couple of million from these other management team as well. So very good to see that the ones we have data for, these people in the management team are aligned with shareholders. So they have skin in the game, and that's really good to see. Like we said, 5.3 years average tenure, good. There's not high turnover, so they're considered experienced. And the same thing with the board members, right? That's what I also do here. So look through all their client profiles, basically see what their tenure is, how long they've been there, how much they're being compensated, if I think it's fair or not, and then ownership. And so having a look here, it looks like all of them, again, have at least a few $1 million invested, except for a few with a couple $100,000. But it kind of makes sense. They've only been there 1.5 years. So yeah, good to see that there's basically a board team with skin in the game. So I'm pretty happy with that. And same thing again, average tenure is 5 years here, so pretty good. They're all considered pretty experienced. So, sorry for dragging on, but the last section I go through is the ownership section. I basically just want to see who the biggest shareholders are and if there's been any major buying or selling from them, right? And so the trend I'm looking for here is if there's like multiple insiders who've been selling large amounts of stock, or if there's multiple insiders who've been buying large amounts of stock, right? In this case, there doesn't really seem to be any discernible trend, right? There's no real trend like what I was just talking about then. So one person sold $42,000 6 to 9 months ago, and one company or business company sold $2.1 million 9 to 12 months ago. So really no discernible trend, so I'm not too concerned there, but that's what I would keep an eye out for otherwise. Not too concerned here, very non-significant to me. And the next part I look at is just the ownership breakdown to see who has the most say in terms of like votes at the company's AGM, to see who has the most sway. And it seems like institutions own like two-thirds of the stock. General public has like just under 20%. Insiders like James McKelvey and Jack Dorsey have like 14% of the stock, and the other management team. And these other entities have like less than 1%. So, okay, here's what's interesting, right? So shareholders have been diluted in the past, with total shares outstanding growing by 2.3%. Okay, so 2.3% is obviously a shame, but considering how quickly the company is growing, I don't think it's too big of an issue, right? Like, I'm looking at this pie, and if I'm a shareholder, I have a slice of it. But if that pie, if my slice just got 2.3% smaller, I'd be disappointed. But if that pie grew by like 40% or whatever, I wouldn't be disappointed, right? Because like while my percentage slice decreased, the value of my percentage increased, right? So I'm not too concerned by that. Like, yes, it's a shame to see shareholders have been diluted because it's probably like equity compensation packages where staff members are getting compensated through stock. 2.3% versus the company's underlying growth doesn't seem too big of an issue to me. So yeah, next section I look at is just basically the top shareholders, who the biggest ones are, and how they've changed their shareholding in the past 2 reporting periods, right? Which is what this column here is. So as we saw, it's like institutions, which is like Vanguard Group, Morgan Stanley Investment, BlackRock, stuff like that. They are typically the biggest shareholders, as well as Jack. And what I want to look for here is if there's any large underlying trends of like buying or selling. So any big changes in people's positions. So obviously they've got a couple of $1 billion invested each of them. And if there's like large purchases of like 5, 10, 15%, I want to have a look at it and then basically see if there's any consistency about that, something occurring over multiple top shareholders. And so it seems like a lot of them here actually have been increasing their position a bit, 59%, 35, 45, 21, 27, 212. That's a lot and interesting to see. So it seems like they're very bullish on the stock. And then we've got these other shareholders here who've actually been decreasing their positions, 23, 11, 5, 8, 1, 2, 26, 31, 54 gain, 23 selling. So a bit of both, right? Like I can see that the bigger shareholders are actually adding to their position, whereas the smaller ones are actually selling off some stocks. So not too much of a takeaway considering there's both sides, right? There's plenty of buying and plenty of selling. If it was all red or all green, then I would be concerned, right? I'd be like, okay, everyone seems to be offloading or loading up on stock. Is there something I'm missing? But in this case, there's nothing too concerning from my perspective. So basically, that's me having finished the company report. Basically, the takeaways from that was like, well, the company is expected to have huge earnings growth. However, its current latest reporting periods of earnings seems quite elevated considering there was a one-off item that actually like maybe temporarily increased earnings. So while it's expected to have really high earnings growth, it's actually expected to dip a bit over the next year because that was contributed by a one-off item. So I need to go and look at it more longer term and basically look at the underlying business, look at the spaces that it's in and it's operating in, and try and figure out, okay, where do I think this company can be in 2, 3, 4, 5 years' time? And then more specifically, like where do I think its earnings can be? And so what I'll go and do is I'll go and research the stock. I'll go and read through all those articles I was talking about, the bullish and bearish pieces, to try and get a bit of a perspective on it. I'll try and have a look at the valuation to see if because it's actually not 155 if I take out that one-off item, it's more like 286 or something. So I'll need to keep that in mind. It's like I'm paying a P multiple of 286, which is incredibly high. So those are the aspects I've looked at, and those are the aspects I'm going to look at. And like I said, there's been some dilution the past year, but it hasn't been a huge issue. So I'm just going to keep an eye on that. I'll go and look at the company's annual reports, and I'll look at how much they rely on equity compensation to compensate their staff, right? Because if there's a lot of dilution that's expected to happen in the future, that could be an issue. But if it's not too big of an issue compared to how big the company's or how large the company is growing, then it's really not a major issue. So yeah, that's where I'm at. I'm going to keep it on my watch list because I'll keep getting updated on the reports and any sort of updates the company's got. But yeah, that's where I'm at, and I hope that video has been helpful. Thank you so much for watching.